And on behalf of the IMIA Executive Committee, I'm very happy to welcome all of you on our today's webinar. This webinar is a part of very important work of our permanent working group on engineering insurance statistics, which is presented every year on our annual conference. We've had a lot of queries from the IMIA members and engineering insurance community on actuarial questions, how we use statistical data we've got from members and other information. And today, Sophie St. John, a member of Statistics Permanent Working Group, will give us a detailed answer on the question how to read triangles. In the beginning, Sophie will give you the brief summary of the presentation. Just a few words about Sophie. She's a head of pricing for international construction at AXA XL. She holds a master's degree in actuarial science, and she's a qualified actuary with the French Institute of Actuaries. She joined AXA in 2014, and before she held a variety of reserving actuary positions in consultancy firms in London and New York. Before handing over to Sophie, I would like to draw your attention to small housekeeping rules. We intend to have a presentation of about 45 minutes. Usually we have a Q&A session afterwards, but to encourage more lively discussion, we are proposing you to ask your questions directly in the chat. And in the presentation, you may raise your hand and ask a question, and Stephanie will allow you to speak. If the question doesn't get answered, we will email you in due course. We will record the webinar, and the recording will be added to IMIA website within the couple of days. The presentation will be uploaded to our website also after the webinar. If you need any attendance certificate which might be useful for CPD or IDD purposes, please contact Stephanie or myself. And with this, I'm finishing with my small introduction and handing over to Sophie. Sophie, the screen is yours.
Okay, thank you, Marina. So as you said, so my name is Sophie St. John. I'm a pricing actuary. I've been a reserving actuary also in the past. So I know the topic of triangles quite well. And today I will present you a webinar on those lost triangles, and we called it How to Read Triangles. Before getting into the main topic, I would like to say a few words about the permanent working group that works within IMIA, that we are dedicated to data and statistics. So we are 5 members to that group, and every year we prepare the market, so the survey that is given to the market, and we compile those results and provide those market indexes that you would have seen. The survey last year was presented in September. So the results were presented in September 2021, and we just sent out the data request for 2022. So it's been sent out a few weeks ago, and we are waiting for contribution. So we haven't received many contributions so far. So it's definitely a great great thing to contribute to that survey. Without your contributions, we cannot compile those indexes. So that would be really a shame. The official deadline for contributing is the May 30th, but we will extend that deadline. So if you have information, if you've contributed in the past, you haven't had a chance to pull the data together yet, you will have more time to do it, and please do it. Otherwise, we won't be able to compile those numbers, and we will lose some very valuable information for the market. So a few things to know that if So only the IMIA members and the contributors have access to the results of the survey. If you contribute, you can receive aggregated data. So you can, if your actuaries are interested in looking into that data into more details, they will have access to that aggregated information. And if you haven't received the email with the data call, please let us know, and we will. So you can put it in the chat in that presentation, and we will send you the email with all the details to contribute. So that was another side point, but quite important for us. So I'm going to move now to the main topic for today, that are the loss triangles. I divided the presentation into 5 components. First, I will, sorry, just excuse me. I'm losing my voice, I should be better now. So the introduction, I will talk about just the basics, like going back to basics. What are claims ultimate? What are they made of? Then showing you what loss triangle is, what are the definitions of those loss triangles, how we use them to get to ultimate, to get more information out of them. So I'll introduce you a projection method. So those 3 first part are more general concept, and then I'll give you information about the specificity of the construction triangles and construction reserving in general. And finally, I'll show you the results from 2021 survey, where we build a loss ratio index thanks to the triangle provided by the contributors. So that's our contents for today. So that introduction on the concept of claims ultimate. So why do we need claims reserves, and why do we use triangles? That's really what we want to cover on those points. So you would expect work in an insurance company, so you know we receive premiums and we commit ourselves to pay claims when losses occurred, if they are covered, if those losses are covered. So the process can be summarized as a policyholder signing up for an insurance contract and paying the premium. Then it could be a one-year policy or several-year policy, but the insurance company will start earning that premium, and during the duration of the policy, claims occur, and claims will occur at different times, and they will change over the life of the claim. So it will be known by the insurer not all the time, not at one time. So that means that the insurer has to reserve for the claims, and they also have to pay for those losses during the lifetime of the claim. So we need those claims reserves because there is an uncertainty on the amount and the number of the claims covered by a contract, and we want to be able to pay all of the losses, so we need to reserve early on for those. So the triangles are used for that purposes. In those triangles, we have claims information from our past experience, and we will use it to assess what our ultimate claim charge will be. I have a few definitions I want to cover. The ultimate claims, they are constituted of different amounts. So the first item are the paid, so that the amount that has been paid for a specific claim. Then we have the case reserves. Those are the liabilities for the claims amount that will be paid in the future. So they've been estimated for each reported claim, and the estimation is done by the claims handlers. The paid plus the incurred plus the case reserve, sorry, they are summarized, like the name of those two items together is called the incurred claims. And on top of that, we had another reserves that we called IBNR, which stands for incurred but not reported claims. And the sum of those three items, the paid, the case reserves, and the IBNR, they constitute the ultimate claim amount. So the final amount we expect to pay for all the claims observed for a specific policy or a specific line of business. It's like the final loss amount we expect to pay. Those IBNR are important because they represent so what has not been reported yet. We have two kinds of IBNR. We have the IBNYR, which are the incurred but not yet reported claims, or we also call them the late claims. And the other component of IBNR are the IBNER, which are the incurred but not enough reported claims, and those relate to known losses where we already have reserves, but in some cases the reserve might be understated or overstated. That's why we say that those IBNER, they can be positive or negative, depending if the claims has been over-reserved or under-reserved. And those are important components, and those are so this IBNR is a component estimated thanks to the triangles. So I'm covering those topics, but I will get into the details in a couple of slides, so you really see how everything is connected. The next slide I have, or the last slide I have on those claims ultimate concept, it's kind of the same idea as what I just explained, but displayed on a timeline. You have a loss at t equals 0, so a loss at the beginning, of course, nothing, so there is no case reserves, no paid, just a loss happened. Here it's an example. I'm saying 1 month later, but it can take longer, it can be shorter, depending on the type of the loss we are having to look at. But a certain period after the loss occurred, there is a preliminary estimate of the loss amount that is put in the system. So here I just said 500 euros of case reserves for that loss. We do not know, we don't have a lot of details about that loss, so we have set preliminary estimates that are several amounts depending on the type of loss. But here in that example, I'm saying, okay, let's put 500 euro as a primary estimate. And then 6 months later, we have more information about the claims, and we adjust the reserves, so they are adjusted to 1,000 euro. Sorry. And finally, 12 months later, the claims is paid. The reserves were correct, so we pay 1,000 euros, and that becomes our paid amount. The case reserves decreases to 0, and our incurred remains 1,000. This evolution of the claims amount over time is nicely seen on those graphs, where here I'm showing with development years, but as time goes on, we know more and more about the loss, and the incurred amount will increase until reaching an ultimate amount. That's what the 100% represent here. The curves can have different shape depending on the type of business. If it's a short tail line of business, we're going to get the losses much faster and reach ultimate quicker. If it's a long tail line of business, it's going to take a few more years before reaching an ultimate value. Those curves are important because that's what we want to show that's what we show in a triangle. So that's a triangle on the screen at the moment. It's basically claims amount that are displayed in so in that set format. And what we show is in rows, we show an accident year or the underwriting year. So I'm going to talk about it as an accident year, just to explain clearly what we are displaying at the moment. So on the left-hand side, you have accident years. So if a loss occurred in 2006, the claims amount are going to be in that row, in the 2006 row. And the column represents the development of that loss. So after year one, so here I'm showing year of development. After year one, all the claims that have occurred in 2006, they have an amount of 55.9 of incurred. That's the vision after 1 year. After 2 years, so at the end of the second year, those claims amount have increased to 72.5. And then after the third year, they will increase to 77.5. And then after the fourth year, 83, and so on. So what's very interesting into displaying the information this way is that you can see old, they're called old underwriting year or old accident year, that we are hoping if it's a short tail line of business, you should see the claims amount kind of leveling off and no longer increasing. And the most recent years at the bottom will not be fully developed, so they will need to be, we know they will continue to increase over time. And what we want to calculate is that ultimate loss is how much is going to be the last column of those rows once they fully developed to ultimate. So that's really the concept of those triangles, is displaying in that shape those curves. And thanks to the projection methods I'm going to show you in a couple of slides, I'll explain to you how we can define guess patterns, or find patterns in those triangles and use those patterns to project to ultimate. The next slide is what I said, but basically kind of written down, just saying it in plain explanation, that the triangles are a useful way of both thinking about the claims and presenting the emergence of the claims information over time. The components usually exhibit identifiable trends over time, and so that allow estimating ultimate losses easier. In those triangles, we can put cumulative paid losses, so we can just look at the paid, not look at the case reserves. We can look at the incurred cumulative losses, so both the paid and the case reserves, and see how they evolve. You can look at number of claims to see how many more claims you expect to emerge. We can also look at premiums. If you know there are delays in reporting the premium, or you have policies that are of a long duration, you can use triangles to project what the ultimate value of premium should be. And the number of years included in the triangles, it varies on the data available. The type of loss, so for some losses, like corporal losses, bodily injury losses, that can take a lot of time to get information, and then there are maybe a lot of lawsuits, a lot of things can happen that can mean the loss takes a lot of time to reach their ultimate value. In that case, we'll need a large number of years, because you need to have years that are close, if not fully developed, in order to use the patterns from those old years and apply it on the most recent years. And of course, the relevancy of the losses. If things have changed over time, the old years may not be as relevant to project the new years. But actually, I'll talk more about that point, that specific point also, and in the rest of the presentation. Just a comment on something you did when I presented the triangle. You can present the rows as accident years or underwriting year basis. So if the triangle is on what we call on an accident year basis, it allows to analyze the pure development of the claims. It's not impacted at all by the duration of the policy because it's the accident year, so your starting point is the date of loss of the claim, and then you just look at how many months or how many years it takes to that claim to reach its ultimate value. It's usually more stable than an underwriting year triangle, and the reason for that is that the underwriting year triangles, they are themselves so impacted by the duration of the policy, because you will have the underwriting year on the rows, and then the claim, if it's a, I don't know, if it's a 3-4 years policy, the claim may happen during the first year, but they may also occur during the 4th year of the policy. So it will mean that a loss will be at different places on the development of the triangle. So it's not as stable as the accident year triangle for that reason. And it also has longer development pattern, as you would expect, because of the delay between the start of the policy, I mean, and the end of the policy, and the actual premium, the actual loss occurring. So there are pros and cons in using both bases. The underwriting year is quite good to, if you know your portfolio has changed over time, and you know how the mix have changed, and you know how much of an impact it has. So you can really see you can really see the how to say, the experience of each year, and you can really understand how your portfolio has evolved over time. But it's not easy to use patterns that are meaningful, so you need some adjustments and so on. But that's like the fine tuning of those analyses. The next slide is touching on that's a very important point, that those triangles, if you want to be able to use what you learn from them on the most recent years, then they need to be constituted of homogeneous classes of risk. You need to define a group of risks that show similar patterns and characteristics. It can be about the mix of business. So you want to have triangles that are consistent in their mix of policies, but that's not the only thing to consider. You should also consider the size of the claim. So if you look at loss triangles, you do not want to mix very large losses with very small losses, because they won't have the same development patterns. So we split triangles into attritional triangles, large claims triangles, and sometimes we look at CAT, natural peril, separately. So we try to look at the claims that behave the same way, basically. You may want to split between bodily injury claims and material claims for the same reasons. They have different behavior. And for construction specifically, what we would do is look at annual policies and project policies differently, because the loss can be different, and also with always the consideration of the underwriting year triangles. The policies have different durations, so you would not want to mix them into one one triangle. So that's something to keep in mind. So have a perimeter small enough so the data is homogeneous. But of course, there is downside. If it's too small, it can be quite volatile. So it needs to be large enough that you have a significant number of observations and you're able to draw conclusion from the analysis of the triangle. So those were the first two parts with kind of the definition, setting the background. The next part is about, so what do we do once we have that triangle? What are the methods to estimate that ultimate claim view? And today I'm just going to touch on one, the most famous method, that is called chain ladder. That's the one that is used a lot. That was one of the first methods to project ultimates from triangles. It has limitations that I will touch on in my last slide. What you should know, so it's based on a strong assumption that the accident year or the underwriting year, so that the rows, they follow the same development pattern and that their behavior will be also the same in the future. So we want to be sure that the patterns we observe on the old underwriting year, that they have reached ultimate already, so that we know the pattern. We want to be sure that we can apply it on the most recent years. It's true. It's only true if the claims, so the claims handling is quite important. We want to make sure that it hasn't changed over time, so it needs to have been consistent. Otherwise, there are techniques to adjust the triangles. So it's not impacted by the fact that maybe 10 years ago, the claims were settled faster for X and X reason. Today, the claims handling strategy has changed and the case reserves are set in a different way. That means you can't really use the information you have from the prior years for the most recent year. And that's why it's important to choose an appropriate number of years in the analysis. I have a couple of slides that shows you exactly how the math worked, to be very clear. So that chain ladder method, it can be applied on premium, and we use it a lot on the cumulative paid and incurred triangle. And in practice, what we do is that we calculate how much the claim, so if I talk about incurred claims, how much the claims incurred have increased from one development period to the next. And so we calculate a ratio of two of the numbers in the triangle. So in my example here, I'm showing like in an accident year 2020, we calculate the ratio of the vision at 24 months, which is 17,613, and the vision of the claims incurred 12 months earlier was 6,469. So we calculate the ratio on one to the other. So we do 17,600 divided by 6,469. That gives us 2.72. That number 2.72 is called a link ratio. And so what we do is that we calculate the link ratio for every cell of the triangle, every point of the triangle. And that shows us so how much, it's quite simplistic in a way, how much things increase at each period. And then we take averages of those link ratio. So here I'm showing the red boxes is basically saying we take a weighted average. So in average, the movement between 12 months and 24 months is the 3.3 you see at the bottom. So the claims incurred will have increased by 3.3 1 year later. And then the increase at 36 months, and then the increase again at 48 months of 1.31 between the vision 48 and the vision 36. And we do that for each development month. And I'm moving to the next slide that shows you that same example, but with the triangle completed. So earlier, I'm moving back, you would have seen the yellow part is empty. So we just see the pink part is the triangle. And now we have been able to complete the missing points in the triangle until the ultimate view of those accidents here, where they're going to end up. So looking at the description I put on the slide, I mentioned the fact that we do averages of these link ratios. They are also called loss development factors. I should have mentioned that. So we do averages of those loss development factors. There will be a selection, judgmental selection made, because sometimes we need to do some smoothing because there can be some movement in the years. Triangles might not be very stable, so there is a selected development factor, a selected pattern, basically, at the end. If we don't have enough years in the triangle, then we need to do use what we call a tail factor to estimate the parts that is missing, because we don't have enough history in order to really calculate what the ultimate value will be. So that's in a nutshell how things work. I mean, it's not very complicated. There are a few limitations to the chain ladder methods. So as I mentioned, there can be some what we call jumps in the triangle, because there are some large losses that even if you look at a triangle of large losses, of course there would be some that occur, that can be have a large increase in their reserves during some development period, and some of the losses may have increased at a later stage in their development life, so you can see those jumps. So what we do is that we could exclude some link ratios from the averages to avoid distorting too much the patterns. And then as I mentioned earlier, we also smooth the pattern at the end to also avoid distortions. So I said it already, but it's very important. It's accurate only if the loss development in the past can be assumed to continue in the future. That's really the basic assumption of a chain ladder. And just to mention another, an alternative loss triangle projection that we use, it's called the Bernoulli-Ferguson method, so BF method. And this method is a blend of chain ladder, but also an expected loss ratio that we usually use on the most recent years, where we know the patterns might not be quite appropriate because we only have a few months or just 1 or 2 years, depending on the length of the losses of incurred data. So sometimes for the most recent years, we use a blend of the historical losses development and an expectation of the loss ratio to arrive at the ultimate loss estimate. So that ends the general description of what loss triangles are and how they are used to estimate our ultimates. I have that one slide about construction specifically. And what's specific about it, you would know that construction line of business, it includes several types of product that can be very different by nature. We would insure like single projects that can have very long duration. We also insure annually renewing policies on an open cover basis, on a turnover basis, but they renew every year, so they would have a 1 year duration. The losses would behave differently, also because the size of the underlying project might be also quite different. We have operational policies like machinery breakdown covers. There are also some inherent defect insurance cover provided, so those decennial covers. So it's quite obvious that you could not have one triangle or one way of analyzing construction line of business for reserving purposes. You really need to split out those items. So you look at these homogeneous classes because they have so many different behaviors that you would not be able to draw any conclusion and make incorrect conclusions. So that's what I'm saying. There's a projection of loss estimates, and also the analysis of the performance of those products should definitely be performed separately. Another thing that is quite noticeable for construction is the difference between the underwriting year view and the financial year view. So construction, it's considered to be a long tail line of business, even though the claims, once they are reported, they behave a bit like a property claim, so they can be settled fairly quickly compared to liability claims that can take years to settle. But that line is considered long tail because of the long duration, especially for project policies. So for a project written, let's say in 2015 with 10-year duration, it will expire in 2025. So you can have losses from 2015 to 2025. So you can still have claims reported in the calendar year 2022. That's what I was writing on the slide, because that means that it will impact the results, like the financial year results. They are reported on an accident year view. So if a claim happens during 2022, even if it's connected to a policy that was written several years in the past, it will impact the results of the 2022 result. So it's really something specific to construction. And it means that we need to be careful when we analyze the portfolio, because the results that we see today, they come from prior underwriting years where the things were different, like the rates may have been different, the terms and conditions were different for the mix of business, also even within annually renewing policy or within single project, the mix of business may have changed over time. So today's result, today's financial year result, are not a good proxy to understand how the underwriting year result will end on an ultimate basis. So the analysis of the portfolio performance should be done on both on an underwriting year basis and on an accident year basis. So really, you are able to understand the evolution of the portfolio and what explains the current result and what could look like your result in the coming year, because future results will be impacted by what's written today on an underwriting year basis. So that's really something important I wanted to touch on, that is specific to construction. And the last part that I'll cover in a couple minutes is the result of the 2021 survey. And we cover, we have an index on rate change. We have statistics about major loss, about type of loss. Today, I'm just going to talk about the loss ratio index because it's connected to triangles. So it's published by the IMIA. It's been published every year since 2019. And the way it works, that the contributors to the survey, they provide loss ratio triangles per underwriting year. So always that important distinction that it's an underwriting year view. And the loss ratio in those triangles is defined as the incurred claims over the written premium. And in the 2021 survey, we had received 13 results from 13 contributors, but that those results are aggregated by an external company called Pearl that does the aggregation of the data on behalf of IMIA and only gives the aggregated triangle to IMIA. So as the actuary of the IMIA data and statistic groups, I do not see the underlying data. I do not see the individual company data. I only get the aggregated triangle. And that's what I'll show you next, is that triangle of loss ratios. And what we see is, just to tie back to the presentation I just gave, like those red block, they show what are called jumps, and you'll see it quite well on the underwriting year 2011. Development year 7 to 8, we see the loss ratio moved from 60% to 103% all of a sudden in 1 year. So that's definitely a large loss. We know that's the largest in Colombia, but there are other movements that are not as material, but still noticeable in the triangles. So in terms of the final, like the last diagonal of the triangle, will show you the current loss ratio position. And we see that for underwriting year 2015 and 16, we already have loss ratios that are above 65%. And because of the long tail nature, those loss ratios are still expected to deteriorate because the incurred claims will continue to develop. So these loss ratios are going to increase even more. At the moment, 17 to 2020, it's below 60%, but same comment. I mean, we do not know yet where they will land, obviously. But they expected, to deteriorate. And if you do ultimate projection on those triangle, as we explained earlier, you can see that they could be even higher than 2015 or 2016. And the final slide is showing the same triangle, but on a graph basis, and those are the graphs I was also showing at the beginning. It's like the development of the incurred loss over time, and at some point we see how it levels off and reach an ultimate. And you see nicely, and that yellow curve is that definitely that jump on the 2011 underwriting year. And I think the last comment was on those younger underwriting year. we see they seem to be developing quicker than the older underwriting year. So there might be a difference in the mix of business. So it could be shorter duration of the policy. That's why they develop faster. Or there might be a fear that they might reach higher ultimate loss ratios. So that's what we observe, like analyze and observe when we look at those triangles. So that was my last slide. I hope, it was useful and you learned a few things. And I'm open to answer any questions you may have.
Thanks very much, Sophie. It was very interesting from one side, and I think you made it very simple, which is also very important. To be honest, I do not see the questions in the chat so far. So maybe there are some questions.
Yeah, I see Sharuk has
one person. Oh, Sharuk has got his hand up. I'll just enable him to speak. Go ahead, Sharuk. Oh.
Hello, can you hear me?
Yes,
yeah.
Yes.
Okay. Hello, everybody. Thank you, Sophie. It was a very interesting presentation. I have two questions. One is about the tail factor, how we should determine the tail factor for a triangle, loss triangle, and the other is more general. If we, let's say it's like as if analysis on the triangle. If we would like to exclude some sort of losses, if, for example, a company exit of some markets or some occupancies, how we can actually do this on the large loss triangle?
Mm-hmm. Yeah, maybe on that second point, it's often done to remove what we call it discontinued offices or discontinued policies, and if the triangles, if you want to use it to estimate your later, your current years, and that business is no longer written in those current years, then you can definitely exclude it from your historical data and build a triangle without this data, just for the purpose of projecting the most recent years where that business wasn't there. You still need to be careful to keep it if you want then to estimate an accident year loss ratio. And if that business is still earning through, you need to keep it in your analysis, so you still take into account the experience of of those discontinued offices or policies into your accident year loss ratio for your financial year result. Does that answer your question?
Yes, thank you. And about the tail factor.
And the tail factor, so it's been a while since I haven't done, I mean, when I used to do it, maybe there are more techniques now, but you can fit curves on the development factor. So once you analyzed all your link ratios, did averages and so on, you what I called it smoothing. You can smooth the development pattern. You can also fit some curves on the development factors. I remember we used to use Weibull curves on those development factors, and that allow you to have an estimation of what where it could end and what the tail factor would be. That's assuming your claims follow a statistical distribution. But I know there was techniques that were used. It could be judgmental if you have no information. Try to get some market data, but it's a tricky one, and it has a lot of impact because, of course, it's the last factor, so it will impact the vision, all the dates of vision when you apply your pattern.
Thank you, Sophie.
I think we have another question in the chat. There is a slight improvement in some of the years towards the very later years of their development. Is it being driven by final reserve release or successful subrogation settlements, or maybe some other factors?
So I'm just rereading the slight improvement on some of the year towards the very later years of their development. Do you mean is this being done final reserve? So yes, the improvement. Yeah, I see. Okay. Yeah, it can happen. I think both explanations are correct. It can be that the reserves were too high. So some good news toward the end when the settlement occurred, and we realized that the reserves were pessimistic, and then there are some releases from that. It's a good point on subrogation. That could also be the case that we get some money from third parties. Trying to think if there could be. I definitely had the idea of the improvement in reserves. Yeah, I don't see any other factors.
Thank you. And also there is a question from Daniel. How do you approach developing a loss triangle which has only a few entries? So we do not have so many information there. For example, for large loss triangle where you may not have large losses in all underwriting years.
Yeah, for lab, I mean, you need to have enough data. If you don't, then the whole technique, I mean, especially the channel technique would definitely not work. I mean, I touched on the BF method. It's used when you are on young years and you don't have enough observation. For the large losses, I would say that maybe sometimes triangles are not the best way to look at them, because they are, if you just have 3 or 4 large losses, I mean, yeah, the ones that have settled, they might be very specific. They are not they are not going to give you a lot of information about your current large losses are going to settle. So sometimes it's better to talk with the claims handlers and just have a view on specific losses and put IBNR, just discussing with the claims handler on how much IBNR should I put on this loss, just as a conversation. And there are maybe less statistics involved, but it might be a bit more pertinent and meaningful.
Mm-hmm. Thanks. And also, I think I have the same question as Daniel, but a little bit from other side. In engineering, I'm talking about project policies. We do have standard material damage cover and TPL cover, and also we can see that maybe in some cases the frequency of loss for TPL can be a little bit lower than for material damage. And in this case, would it be right to set 2 different triangles, or they can be mixed in one?
I think if you have enough volume, it's definitely makes sense to get them into different triangles. Because the TPL loss, they will develop quite differently from the material damage losses. So yeah, definitely if you have enough volume, it would be ideal to split them out. If you don't, you can try to look at material damage separately, at least material damage separately, and see how they behave and how adding the TPL loss impact your vision on material damage. Because you don't want to, you don't want them to impact your material damage view because they have a different frequency. I mean, there are other techniques where you could look at frequency triangles and then average cost of loss. So instead of having one triangle with the incurred, where you try to project at the same time, because the idea is we project at the same time the frequency and the severity, you could split the two and have triangles with number of claims. So you project the frequency and then calculate nice average cost per claim with some inflation factor and so on. So sometimes it's cleaner to do it, so you really have a feel about the potential. I mean, I know inflation is a big topic at the moment, so it's also a way to really reflect the proper inflation you expect to see, or how it has impacted your book, and maybe also an improvement in frequency or deterioration in frequency. You can really see the two separate and understand better what's happening in the overall triangle. That's another way to do it.
Okay, thanks very much.
Sure.
And also one additional question. How do you take inflationary factors into consideration, especially at times such as now, where inflation can have quite an impact on claims costs? So you could touch it a little bit. But
yeah, I mean, in a normal context, like if you don't have a strong inflationary context, you assume, like, the underlying assumption in the triangle is that the inflation is it's been the same every year. So if it's been like 2 or 3% the last 10 years, no big deal. I mean, it's not exactly that, but you assume that it was constant. So your pattern has inflation in it. Basically, it's already taken into account into the pattern. So like this year it's more complicated because for the first time we have to really think about, so now I have strong inflation, what do I do about it? There are, and I don't know all the ways to do it, but one way could be to inflate the reserve. So you do your triangle as usual, but you know the reserves you have in the portfolio, you are going to have like they are going to cost you, I don't know, X%, 2, 3, 4% more than they would have costed you when you estimated them. So you inflate your reserve by a factor to take into account the fact that when they're going to be paid in 2022 or 2023, they will cost more than what you thought they were going to cost you. So that's a way to do it outside of the triangle.
Thanks very much. And also one question regarding the triangle's link ratios. Should we generally exclude ratios which are lower than 1 towards the end of the development period or not?
Depends if you want to be prudent or not. I mean, there are line of business where we know the curve, the development of the claims will definitely go above 100% and then come back down. So there are lines where you should definitely not remove the link ratio below 1 because that's how the business works, and in that case you would completely overestimate the ultimate and you need negative IBNR. So there are definitely enough business where there's no question it's okay to have negative IBNR. If it's just a few link ratios and it's definitely not expected, then yeah, I'll say I would remove them and try to flatten. If I know I already reached ultimate and it's not expected that I should get recoveries and it's just a couple of years, then I would remove them.
Thank you. I can see no more questions. Maybe there are some.
I can't see any more questions, and nobody is raising their hand at the moment, so I think we're done.
Okay.
Okay.
Wonderful. Perfect timing. Thanks very much, Sophie, again for the great presentation. It was very interesting, and as I said, it was very simple to understand. Even you have no actuarial background. Thanks
Okay,
again.
good. Thank you.
Thank you, and I wish you a nice week.
Thank you.
Thanks very much.
All right. Goodbye. Thank